welcome back to Axe Ed. Today, let's talk about stocks. What are they and how can they benefit you and your wealth? Well, let's start with what is a stock. So let's first talk about private companies. When a company is private, that means it's usually owned by just a few people, typically the founder and maybe a few investors who help the company get off the ground. Those few investors and the founder own pieces or percentages, or what are called shares, of the company. That means each of those investors gets a profit from whenever the company does well and grows. When a company grows big enough and thinks that it can take on many investors, it will turn to the public market and become a public company. This is what is known as an initial public offering, which turns a company into publicly held on the stock market. This means that anyone that has access to the stock market via even a computer, simple internet connection, or a stockbroker can go and buy a piece of that company and become an investor in the company. Now, there's a complex process that determines that initial price of every share and how many shares there are. That is beyond the comprehension of this video, but what happens is an initial price is set and an initial amount of shares are created. Then anyone can go and buy and sell those shares on the open market during trading hours. When you buy a share, you're physically buying a share from another person who owns that share already, that other investor. When a person wants to sell, they're putting their stock up for sale at whatever the market price is or whatever price they are trying to sell it at. Basic laws of supply and demand determine the price from then on. Therefore, a company is really only selling its own shares at the initial public offering and maybe any subsequent public offerings, but those are rare. When a company is doing well, or people expect the company to do well in the future, they will be offering to buy that share for a higher and higher price. That causes everyone's market price of their shares to increase over time. Now, the opposite is true when a person wants to sell a share and thinks that the company is going to decline in the future or is expecting it to decline. Then everyone is willing to sell their shares at a lower and lower price because they just want to get out before things turn really bad. Now, it's worthwhile to note that there are micro and macroeconomic trends at play here. Microeconomic trends, in the terms of the business itself, are the performance of the business and what individual investors expect of that business's performance in the future. Macroeconomic trends are things that are above and beyond the business's performance itself, like trade wars or inflation or the overall economy's performance. Those two things put together determine how investors are going to buy and sell that stock. Now, you may notice that a stock's price can fluctuate very rapidly on a day-to-day basis, and that's usually because of the daily news that's happening or some sort of news that breaks about that business's performance or macroeconomic trends. So-called day traders take advantage of these daily fluctuations, but it is risky. They try to buy low and make a quick buck by selling high on the next fluctuation upward. Generally, the average person isn't going to be a day trader. That's because it takes much knowledge of a business's performance and macroeconomic trends, and sometimes just luck to make a quick buck every single day. Most people are going to be long-term investors, whether that's through their 401k, an IRA, or just individual stock ownership. About 50% of Americans hold stock in some way for their retirement or just individual stock holding. Why is long-term stock investment a valuable thing for you to consider? Well, that's because inflation, the average increase in most goods year to year, is around 2%. That means in a given year, most goods will be about 2% higher than they are at current times. On the other hand, the stock market on average grows around 7 to 10% year over year. Of course, there are many days where the stock market declines and some years where the stock market declines, like in the 2008 recession. But if you're looking to be a long-term investor, the greatest thing to do is to just average in. You might just keep buying every single day or every paycheck or every month. Sometimes you'll buy high, sometimes you'll buy low, but on average, over time, you'll likely track the stock market. If you don't have the time and resources to commit to learning about a company's individual performance and macroeconomic trends, a great option is an index fund, which literally tracks the overall stock market's performance. So if the overall stock market, like one of the indexes, the S&P 500, which is a collection and rating of all the top 500 businesses in the United States, if that index grows at 7% in a year, so will your index fund. Now, in order to start investing, you can simply access an app like Robinhood or an investment brokerage firm like Fidelity and just put in a couple bucks every paycheck, or even download an app like Acorns, which will put a couple cents on every single purchase into purchasing stocks. Those index funds are an easy way to just average in and track the stock market. You don't have to watch it every single day, and then in a couple of years, or maybe once you reach retirement in regards to your 401k or IRA, you'll be able to sell those shares, pay a little commission, and gain whatever that investment has been. The key to long-term investment is time and patience. The stock market may fluctuate day to day, but you shouldn't get too worried about that. Usually, the stock market will grow in the long term, and you'll make more than if your money just sat under a bed or in a bank account where there was no interest gained, or even a savings account where the interest gained is super marginal. Now, there are of course risks to consider, like an economy's growth or a business's performance, but on the whole, the stock market has gained higher than inflation, and especially higher than savings accounts or just sticking your money under a bed, where it actually loses value over time. Now, keep all of this in mind, and if you have more questions, reach out to a financial advisor, as they can help you figure out your individual situation. But maybe start today, because time is the thing that will create the greatest amount of wealth for you. Thank you for watching. This has been AxeView.